Hi, Mark Anderson here, mortgage banker with Paramount Bank. I'm licensed to lend in all 50 states, and I would love the opportunity to earn your business. If you'd like me to evaluate your mortgage scenario, you can call me or text me at the number below anytime. All right, for today's mortgage rate update, first thing to say, it has been far too long since I've done a rate update. This was really my loss overall because rates got down to their lowest levels over the past week and a half or so. We saw plenty of scenarios that were at the same level as the lowest pricing that was available that first popped up in early March. I did have to make a judgment call from a time management standpoint. I had to prioritize working with the clients that I have. And so from just a time management standpoint, I just didn't have the bandwidth to put these videos together. Things are, I wouldn't say calming down, but I've been able to carve out some time, and I really do want to prioritize putting these together, especially as it looks like things are beginning potentially to change. The big news for today in terms of mortgage rates, you'll notice that the stair-step chart indicating our distance from the lowest rates expressed through steps is we are one step above the lowest rates that have been available during this, this major cycle of low interest rates. So we're still very, very close to the bottom, but we're not quite there. And one of the reasons why is there were basically three key economic reports that came out today. The primary report being a ADP payroll report indicating that unemployment or new job loss claims were much lower than expected. I think the expected amount was somewhere in the 9 million range. Of course, you saw last month we were up to, I believe it was over 20 million, which, I mean, these are just truly insane, crazy, scary numbers. So the fact that they were expecting 9, the actual result came into just under 3 million. So this, in a very odd way, is seen as positive news because it's not as bad as certain people thought it would be. So that's been interpreted as a positive sign. You've seen the stock market jump up across the board, very big rally there today. And this brings us to basically the age-old association between the stock market and the bond market. Now, again, the bond market is really what drives mortgage rates. And generally speaking, although a lot of these rules of thumb have been completely tossed out of the window over this low rate cycle because we're in a very artificial market, it still is generally the case that when the stock market's doing well, bond prices typically suffer. So you see more people are putting money into stocks. They're taking money potentially out of bonds that are seen as the safer but kind of less sexy investments. You're not going to make as much money on them. So when people take money out of the bond market, they put it into the stock market. That typically will cause interest rates to get a little bit higher. Now, the actual change in terms of the bond market, we can look at the chart here. This is just today. You see we started the day at this bond price level on this 30-year 2.5% coupon at about 103.75. We've lost essentially a quarter of a point in terms of the bond price. To put this into context, which I think is really critically important, if we look at the last month, you can see we're right now at 103.6. We've been as low as 103.27, and we've been as high as 103.89, it looks like. One important thing to point out, and I've stated this in previous videos, but just to refresh, the bond prices themselves no longer, over this low rate cycle, they no longer have as direct of a relationship with the day-to-day changes in mortgage interest rates as they typically do in what we'll call, for lack of a better descriptor, a more normal market environment. The big case in point there is this fundamental fact right here. This is the point in early March with a bond price of 102.61 that we saw rates dip to their lowest levels. Over here, we have significantly higher bond prices over basically the last 3 months, much higher than here. But it wasn't until very recently that the actual mortgage rates that were on offer were as good as the rates associated with this bond price. Again, it's a much lower bond price. So this is all very complicated stuff. The takeaway for anybody that's evaluating whether or not to lock in a loan, I would say you're going to be on the lookout for a couple things. On one hand, if we continue to see positive economic data, which again, I kind of can't imagine that only 2+ million people losing their jobs is at all seen as a positive, but it is, because it's not as bad as it could have been. If you see any positive economic news, if you see the stock prices going up, if the reports that have come out today are an indication that maybe the ship is righting itself in terms of the economy, the low rate ship will likely sail away. Now, the big question there is, how much are we talking about? Like, what's the actual scale of that? Everything that I have read, which I try to stay away from people that make bold claims about this is going to happen or this is going to happen. Probabilistically, it looks like that rates are going to continue to remain, let's call it relatively low for the foreseeable future, whether that's 3 months or 6 months or 12 months. It seems that we will be in a low interest rate environment overall. But that low interest rate environment may not be as low as what we've seen over the last couple months. I would say that if you've been on the fence for a while, and maybe you were waiting for rates to get better than the low point, I had made a video that I'm going to copy into the description here, where I essentially made the prediction that there was no reason that I could determine that rates would actually fall below those lowest levels. And for whatever reason, I can't claim it's, that I have remarkable abilities of prediction. It just seemed to make sense to me that we had reached kind of a technical bottom end for mortgage rates, and that something really, really dramatic would have to happen, whether it was increased Fed intervention in the market or something really big and market moving like that, for the rates to really fall lower than those lowest levels. So if you've been waiting around for that to happen, I hate to say it, but it doesn't look like that's going to happen anytime soon. Again, barring anything completely unforeseen. Let's say there's a less than 1% chance of some unpredicted outside force that could make that type of change. But I think it's very unlikely. The most likely thing that I can see at the present time is that rates, possibly over the next few days, are going to get, let's call it, marginally worse than they are now. We're maybe talking an eighth, maybe a quarter of a percentage point. That's my best guess based on what I see in the market for right now. So I would be more than happy to take a look at your particular mortgage scenario. We can cover some real-time interest rate and fee information right over the phone. I can, of course, follow up that phone call with a written proposal so you can see everything. But I'm finding that is the most efficient way to take a look at your refinance options. Let's just have a conversation, go over the real-time information. I've got all sorts of spreadsheets and ways I have of running the math, so we can run cost-benefit analysis. We can take a look at interest payments over time. We can really go deep on the numbers. And I do recommend just setting up a phone call so that we can do that. Thank you very much for watching. Please do like the video. Please subscribe to the channel. I'm going to do my absolute best to put some more content together and be more consistent about it, but I really appreciate you watching. Thank you very much.